So what does the presentation look like? First, we will review the status of climate change prior to the arrival of the pandemic. Then we will look at how the COVID-19 pandemic will affect the world economy, energy use, and climate change in the immediate future, before looking at our predictions for the longer-term effects of the pandemic on climate change. Global temperatures are tied to the composition of the atmosphere, particularly carbon dioxide, throughout Earth's history. The main chart shows the concentration of CO2 in the last 400 million years, estimated from the fossil and geochemical record. The scale is logarithmic, so what look like rapid changes on the left-hand side happened over tens to hundreds of millions of years, whereas the current increase in CO2 levels is happening over decades. We can see glaciation and the development of ice caps associated with low CO2 levels, and the high CO2 levels associated with perma-Triassic heat, and 97% of all species went extinct. The pie chart on the top left shows the breakdown of greenhouse gas emissions by gas, with CO2 clearly in the majority. 80% of those CO2 emissions are associated with the burning of fossil fuels. The chart on the bottom left shows the concentration of CO2 in the atmosphere, which has increased by 100 parts per million since 1960, and was measured in May this year at 416 parts per million, which is the highest recorded level in the past 20 million years. Methane, the second most potent greenhouse gas, is playing an increasing role. The chart at top left shows the concentration of methane in parts per billion in red, CO2 in parts per million in blue and black, and nitrous oxide again in parts per billion in green. Methane concentrations have risen at twice the rate of CO2 since 1900, as various emissions overpower the Earth's ability to absorb. The proportion of greenhouse effect from methane has risen from 10 to 16%, and it accounts for 25% of the annual increase of greenhouse gas effects. Fossil fuels contribute 1/3 of methane emissions, and the oil and gas industry's emissions have increased from 20 to 24% of the total in the past decade. We have to find ways to correct this. Solar radiation and ocean currents play a short-term role in global temperatures. Solar maxima at 11-year intervals and El Niño currents at 2 to 7-year intervals are associated with warmer ocean temperatures. As the oceans warm, El Niños are getting stronger. If a strong El Niño occurs in the coming solar maximum, which is 23 to 26, temperatures should far exceed the record year of 2016. To reinforce the message that the impact of greenhouse gases is real, here's a chart showing the correlation between CO2 concentrations in the atmosphere, represented by the gray line, with the red and blue bars representing the difference between annual temperatures and the 20th century average. I think you'll agree the correlation is very clear. It's important to note the acceleration of both of these since the 1970s, the dramatic increase in CO2 emissions beginning after World War II. 43% of current CO2 emissions from fossil fuels are coming from coal, with 34% from oil and 18% from natural gas. The remaining 5% comes in the main from manufacturing cement, and a surprisingly small amount from gas flaring, where most oil and gas companies appear to be concentrating their efforts. Coal emissions increased 60% in the 10 years from 2002 to 2012. CO2 emissions vary substantially for different fossil fuels, being highest for coal and lowest for natural gas. Different oil types also vary widely in CO2 emission levels. The heavier the oil, the higher the emissions. But of course, flaring significantly increases the greenhouse gas emissions of some lighter oil production. So how is the oil and gas industry responding to the climate change challenge? There are 3 ways to measure this. Have companies committed significant financial resources to low carbon technologies? Is the shift to lower greenhouse gas emission hydrocarbon production of gas and ultralight oil taking place? And has there been an effort to reduce natural gas flaring and venting, more importantly? The 2 charts on the left show investment by majors and selected other companies in new projects outside the oil and gas supply. The main focus in 2019 was in solar PV, followed by wind, Total, the most ambitious investor by far, is investing over 4% of their total capital spend, but other companies are half of this or less. Looking at the chart on the right, which shows the carbon emissions index for the majors, we see that Exxon and Chevron produce the highest greenhouse gas hydrocarbons, with Exxon still increasing, while the European majors mostly show decreases as they move towards gas. Let us turn our attention to the COVID-19 pandemic, although I have to caution that, as this is a recorded presentation and the COVID-19 situation is evolving rapidly, some of the data may be a little out of date. In advanced economies, particularly in Europe, the first wave has peaked. Will there be a second? And will the US regain control? In emerging and developing economies, the first wave is very much still in progress. We are very aware of this here in South Africa and concerned regarding the future trajectory within Africa. The continuing increase in Brazil and other South American countries is also of great concern. Certain areas, such as Australia and New Zealand, appear to have escaped the worst. So let us review the status of treatment for COVID-19. While the number of cases worldwide is increasing, the number of deaths is dropping. One explanation may be that the epicenters are shifting to areas with younger populations. As we know, the older members of our communities are particularly vulnerable. In addition, at least 3 treatments have emerged for the disease. Antibodies recovered from previous COVID-19 patients can assist others. This is not new. Plasma treatment has been used for more than 100 years to treat other diseases, including measles, polio, smallpox, and SARS. The limitation is on the amount available, as the plasma from one patient can only really treat 1 to 3 other people. An extension of the above, where antibodies are cloned from recovered patients, goes some way to addressing the availability issue. Remdesivir, an antiviral medication developed to treat Ebola, and other existing medicines, including some steroids, are showing potential benefits, and clinical trials are ongoing around the world to determine their effectiveness. A vaccine is, of course, the surest way to end the pandemic, but any vaccine will only be available in 2021 at the earliest, and no vaccine is 100% effective. And the other big issue? Will there be a second wave later in 2020? Probably yes, as every pandemic since 1990 has had multiple waves, including the Spanish flu of 1918 and 1919, the Asian flu of 57 and 58, the Hong Kong flu, where the second wave in 1969 was more deadly than the first, and swine flu in 2008 and 2009. These waves have had a period of roughly 4 months, and the daily new cases plot for COVID-19 above suggests we're in the middle of the second one, with most of the first one being in China. This leads us to 2 possible scenarios for the global economic impact of the pandemic: a single or a double hit. In both scenarios, the world's economy will not be back at end 2019 level for at least 2 years. In the single hit scenario, there is no second wave, but economic activity falls 6% in 2020, and OECD unemployment climbs to over 9% from 5% in 2019. Living standards fall less sharply than with a second wave, but 5 years of income growth is lost across the economy by 2021. If there is a second wave before year end, the renewed outbreak of infections will trigger a return to lockdowns. We've already seen something like this in several countries, but it is debatable whether this is a strengthening of the reduced first wave due to the relaxation of lockdown or a true second wave. World economic output plummets 7.6% this year before climbing back 2.8% in 2021. The OECD unemployment rate nearly doubles to 10%, with little recovery in jobs by 2021. So how has the pandemic impacted energy use in 2020? And we're looking here at the single hit scenario. The biggest impact has been on oil and coal. Energy use in the Northern Hemisphere was already lower in early 2020 due to the warmest January and February on record. Coal demand was lower due to China's pandemic-induced slowdown in Q1, and coal as a fuel of last resort in the USA and EU in the first half of this year. Oil demand in Q1 showed the reduced use in air and land transport. The reduction in gas demand was less, as it's a preferred power source to coal and suffered less impact from reduced transportation. The nuclear reduction was minor, as it's obviously a long-term power source. Renewables showed a slight gain, demonstrating their viability under stress and indicating likely future gains. The chart on the right shows energy growth by region in 2019 on the x-axis and 2020 on the y-axis. All regions show a decrease in 2020, but the developing world shows far less impact as underlying growth in demand continues. How has the pandemic affected oil supply and demand? The chart on the top left shows supply and demand, with the balance between those as a bar chart. The supply cut of 10 million barrels in May reduced oversupply to 6 million barrels by June and kept inventory build within storage capacity. The challenge in late 2020 will be to keep supply low while we see how demand recovers. On top right, we can see that Asian nations took advantage in April to fill storage at very low prices, which will depress demand and prices in late 2020 and 21. The oil price chart on the bottom left shows the collapse due to oversupply from Russia and Saudi Arabia, plus the further collapse in demand due to lockdowns, with a partial price recovery when OPEC Plus agreed and implemented cuts. As of June, demand for gasoline has not yet recovered in the USA and Europe, despite the gradual reopening of the economy, as the plot of traffic congestion in these countries shows. Looking at the longer-term impact of COVID-19 on oil, we believe that the global demand is unlikely to reach January 2020 levels by the end of 21. Due to low prices and low demand, investment will be severely reduced through the end of 2021. To deplete the overproduction of Q1 and Q2 2020, an average of 1.5 million barrels of oil a day deficit in supply demand is needed through 2023. The most reliable indicator of world oil demand has been world GDP, which is the plot on the bottom right. If world oil demand does not recover with world GDP after the pandemic, it will indicate a fundamental shift in energy use. Moving on to the impact of the pandemic on gas demand, we see that demand has dropped only about half as much as coal and oil due to the pandemic. Natural gas is preferable as a reliable supplier to the alternatives, nuclear based on cost and coal on environmental concerns, although in the USA, gas has also replaced coal due to cost. The two charts on the left-hand side show the LNG price story. The price of LNG has decreased to parity with US gas prices at around $2. Break-even prices for existing LNG facilities are about $3, but new LNG investments require prices beyond $4 to $5, the result that several major projects have recently been deferred. US natural gas prices have been dropping over the last year, but have held relatively steady during lockdown. A third of US shale gas production is associated gas with shale oil production. As US shale oil production drops in 2020, gas production will drop, leading to higher gas prices in 2021. It's interesting that producers in the largest US shale gas play in Appalachia can be profitable at a gas price of $2. How successful were our efforts to deal with climate change in the past decade, and what impact did COVID-19 subsequently have? The record of energy-related CO2 emissions over the last century or so shows how major economic events in the past interrupted the rise in CO2 emissions. The biggest impacts were the Great Depression at the end of the 1920s resulted in a 1.5 gigaton decrease in CO2 emissions, admittedly from a significantly lower base. The oil price rise and ensuing recession at the end of the 70s reduced oil demand. And now, for what we were actually trying to do, With the shift from coal to gas and growth of renewables as a major power generation source from 2013 to 2016, particularly in Europe and the USA, we achieved a flattened CO2 emissions curve, but this was reversed in 2017 and 18 due primarily to increased use of coal as a fuel for growth in China and the developing world. The reduction of 2.5 gigatons of CO2 emissions, and that's 8%, in 2020 due to COVID-19 is the largest single-year reduction ever experienced. How do we continue that reduction, having seen the economic impact of COVID-19? Unfortunately, climate change is continuing to accelerate despite the pandemic. The increase in peak CO2 of 3 parts per million from May 2019 to May 2020, and that's from 414 to 417 parts per million, is consistent with earlier years and pre-pandemic predictions. Despite reduced economic activity and lower fossil fuel emissions, the period from March to May 2020 was the warmest ever recorded for that 3-month period. And the 12-month period from June 2019 to May 2020 also tied for the warmest ever recorded. This is despite 2019 and 20 being a solar minimum and without the El Niño warming current. Where will we see investment in 2020? Total energy investment is likely to drop by 20% in 2020 compared to 2019. Although the share of investment in clean energy and energy efficiency will increase from 33 to 37%, the overall amount of investment will fall. The challenge in the coming years during a likely recession will be to commit the resources needed to shift to a lower carbon economy. Possible scenarios for the energy future after the COVID-19 pandemic fall in 2 scenarios. Recovery from the pandemic with lessons learned applied to that second wave late in 2020, allowing recovery to start second half 2020 and continue through 2021. Or a second wave pushing the world back into deep recession, delaying the economic recovery until 2022 with long-term damage to the world economy. And we see 3 energy paths related to these scenarios. A continuation of the trend of 2017 and 18, with CO2 emissions rising annually in a 1.5% to 2% range. If the trend continues, resulting in a greater than 3 degrees C increase by 2100, a tipping point will likely be reached, resulting in an acceleration of the trend. Alternatively, we could see a reversion to the trend of 2013 to 2016, which requires a transition to lower greenhouse gas fossil fuels while building renewable capabilities in the coming decades, with a plateau of CO2 emissions and a decrease after 2040. This also has to include a reduction in methane emissions. The temperature increase could thus be limited to 2.5 degrees and the tipping point possibly avoided. And the third of those paths is a move to a lower carbon economy. Use the 2020 shift to lower CO2 emissions as the base and continue the trend while finding ways to minimize the economic impact. The temperature increase could be limited to 2 degrees and the tipping point avoided. The key to predicting the energy path of the future will be the status of the pandemic and treatment, the shift in energy use, and the level of international cooperation. So let us examine the first of those energy paths, the continuation of the CO2 emission trend and the energy use of 2017 to 2018, the business as usual case. After economic recovery, the emissions trend of 2017 to 2018 resumes. US and EU emissions decline at pre-pandemic rate as natural gas and renewables replace coal as a power source. Coal use in China and the rest of the developing world resumes the trend of 2019. The Belt and Road Initiative continues, ensuring that the CO2 emissions increase in the developing world is greater than the EU and USA reduction. There'll be no new coordinated global initiatives on climate change, with the Paris Accord essentially ignored by many key countries. And major energy firms continue their current capital spending plans. CO2 global emission levels from fossil fuels surpass the 2019 level in 2023 in the base case and 2025 with delayed recovery. So how do the answers to our three fundamental questions affect the chances of the world taking this path? The status of pandemic and treatment. Continuation is most likely to occur in the delayed recovery scenario, although possible in the base case also. In deep economic recession, investment funds for transition to low carbon economy will not be there, and the emphasis will be on the fastest economic recovery. The shift in energy use. Continuation by definition means bringing back the energy use patterns of 2019 as much as possible. Rapid economic recovery, particularly in the developing world, takes precedence over improved air quality and environmental concerns. And on international cooperation, as in 2020, international cooperation is lacking, ensuring that adherence to the Paris Climate Accord continues to be only partial, and no new climate initiative is enacted. In the second energy path, if we continue the transition to lower greenhouse gas fuels, freezing CO2 emission levels as happened in 2013 to 2016, we will need to see the following. US and EU coal use continues to decline at the 2020 rate. China flattens its CO2 emission levels with no new coal plant construction, and the Belt and Road shifts from coal to clean energy projects. Low LNG costs need to be subsidized in a global initiative to allow the developing world to replace coal with gas. Capital spending of the energy majors shifts to lower greenhouse gas hydrocarbon production, with increased spending on low carbon or carbon capture and removable technologies. And we'll need to see reducing flaring and methane emissions more importantly. And this requires acceptance that oil demand peaked in 2019. And how do the answers to our three fundamental questions affect the chances of the world taking this path? The status of the pandemic and treatment. Transition to lower greenhouse gas fuels is more likely in the base case, where economic recovery puts the world in a position to address environmental concerns. This path is less likely in the delayed response case. The shift in energy use. This path shows a shift from coal to gas in the developing world and an emphasis on lower greenhouse gas hydrocarbon production. This could represent the best opportunity for the oil and gas industry to play a positive role in addressing climate change. Unless methane emissions are also addressed, the gas transition will not be effective. And on international cooperation, this scenario clearly relies on international cooperation. The Paris Accord is amended, strengthened, and complied with. Major gas-producing nations, such as the US, Russia, and Australia, may recognize self-interest in this scenario. And now the most optimistic path, a move to a lower carbon economy, continuing the move to green energy. The world negotiates a new climate accord in 2021 with two key provisions, a carbon tax and a ban on construction of new coal power plants. The USA, Europe, Japan, and Korea phase out coal power by 2030. China and India play a major role, freezing emission levels, moving away from coal, and for China, stopping exporting the coal industry. Subsidies to support renewable replacement of coal power in developing nations with gas or LNG as a temporary substitute. And a major shift in capital spending to renewables, carbon capture, nuclear, and hydrocarbon initiatives. So how do the answers to our three fundamental questions affect the chances of the world taking this path? The status of the pandemic and treatment. The green shift may be possible in the base case, with better economic conditions allowing consideration of environmental options. It's unlikely in the delayed recovery case. The shift in energy use. This option requires a massive shift in energy use. The economic recovery would require increased energy production, which would initially include natural gas, but shift to renewables plus hydrogen and nuclear as quickly as possible. And international cooperation, this scenario can only take place with drastically improved international cooperation. Leadership of several key nations would need to change by 2021 or reverse their views on climate change for this option to be possible. And just to go through some of those impacts of the green shift scenario and the key events needed to accompany it, we need that new climate treaty in 2021. A carbon tax incentivizing a rapid shift to the use of renewables, hydrogen, and nuclear with natural gas in a transitional role. a ban on the construction of new coal-fired power stations, a program with incentives and subsidies to phase out coal power. We need full participation by all nations and a reset of country goals to include incentives for carbon capture and storage, and to monitor and reduce methane emissions with individual country targets. The green shift scenario is similar to the sustainable development scenario proposed by the International Energy Agency. The shift in energy use in 2020 due to the pandemic is a first step in that direction. Oil demand will have peaked in the last quarter of 2019. Coal demand declined rapidly starting in 2020, and natural gas is a transition fossil fuel. Reducing fossil fuel greenhouse gas emissions to 20 gigatons by 2040 is key to limiting the temperature rise to 2 degrees C. So in conclusion, while the COVID-19 pandemic and climate change are separate crises, key lessons apply to both, as well as to energy's future. The pandemic has demonstrated the fragility of the world economic order and the potential of global natural calamities for disruption. The economic pain associated with an 8% drop in global CO2 emissions from fossil fuels is now clear. Are nations willing to accept continued near-term economic stress for longer-term environmental gains? And when energy use has dropped, it's been the higher greenhouse gas fossil fuels, coal and oil, that have borne most of the decline. Is this a temporary phenomenon or a long-term